Market microstructure will be the first lesson where we are going to kick these things off. It is important to understand the market microstructure as it gives you a valuable insight on how markets actually operate. There are many traders who just come into the market and start buying and selling without paying any attention to these things. They end up wondering why they get executed at different prices during the high volatility events, or they just use the wrong order types to mess up with their whole executions. I will take you through the basics of market structure that you need to understand for the way of trading that will be discussed in the whole video lessons. If you are looking into high frequency trading or just kind of a quick discretionary scalping, then you might need to educate yourself a little bit more. But for the way that I believe the 99% people will end up trading, this will be a more than enough for you to understand. So what is the market microstructure? Market microstructure studies the inner workings of financial markets. It covers how prices are formed, how markets operate, the traders' behavior, structure of different exchanges, commissions, and so on. If you go to an exchange and place a buy or sell order, it usually takes just a microseconds for your order to execute, which will obviously end up you being in a trade. Although all of this is very fast, it is quite a complex process for your order to get executed, and what is the most important is the fact that you need to be matched with a counterparty for your transaction. The most markets and brokers do this via something which is called the open auction, where traders just place their trades into the order books until some counterparty fills them. The counterparty can be other trader, institution, algorithm. In some cases, in a spot forex with the B-book brokers, there are actually brokers by themselves, or it can be a market maker. The word market maker is often kind of thrown around as some evil entity that is running stops of retail traders on purpose, but this is not true. Market makers are wanting to just stay basically neutral with their inventory and capture the difference between something which is called the bid and ask spread, and this takes us to the first part of the market microstructure, which is the bid and ask. So the bid and ask represents a supply and demand in any market. In other words, bid represents the prices at which are buyers willing to buy an asset, and the ask, which is sometimes called the offer, represents prices at which are sellers willing to sell the asset. If we're going to take a look at this table down here, you can see that there are 5 contracts resting at the bid, and there are the 10 contracts resting at the offer. For price to move to $9, there has to be someone, and it doesn't matter if it's one person or 5 people to sell into this bid. So the 5 contracts, that someone has to take the aggression to actually sell into this bid, these 5 contracts, for price to move one tick lower. Once this is done, markets will start trading at the $9. The opposite is of course the true. For market to move to $11, someone, and once again it can be one person or it can be 10 different people, have to buy into this offer. So they has to buy the 10 contracts for market to move one tick higher. Here on the right side you can see the simple order book, which is from the Okotoki website. It's for a Bitcoin trading, and this is called, you will see names like order books, the DOM, which is depth of market, and they are essentially the same thing. If I will show you a little bit more advanced order book, it would be this one. Let me just give me a second, because this is you can see it right here. Let me just make it a little bit bigger. This is the DOM for a 10-year German bonds, and once again you can see that buyers, the bids are resting in this blue column right here, and the offers are resting here at the red column on the right side. So for market 2, and you can see here is the spread, which is this price right here. So for markets to move one tick higher, someone has to buy all these offers, and you can see how this is a slow market, but still these things move quite a bit. If you will trade something like Bitcoin, you will see how fast these things will be and how quickly these bids and offers are actually getting pulled. These columns right here that are actually representing the orders that are getting pulled or added to the prices. So you can see someone pulled 38 lots from here and someone added 10 lots in here. Obviously same as the opposite. This is often a good indicator if you see a spoofing in a market, which is spoofing is when someone is putting the orders in the order book without any intention of filling them. So if you can see some sizes getting constantly pulled, that these sellers might not be really interesting into filling these orders. The column in the middle shows the orders that are actually getting executed, and this is a volume profile. This is more advanced thing. If you don't understand it yet, it's okay. I just wanted to show you. We will cover this a little bit later on, so no worries if this is too advanced for you. Looking back into this simplified version of the order book, you can see that here, let me just use this drawing tool so it's a little bit cleaner. You can see that this 48,130 price right here is you can see it right here, and there is 0.2 BTC resting in this price. So if market has to move these 10 prices higher to 48,140, someone has to take the aggression and buy these 0.2 bitcoins. So obviously if someone, for example, would just step into the market and decide to that they want to buy, let's say 5.4 Bitcoin at the market, what the price would be, what would actually happen. You can see that this is hope my math is correct here. Yeah, if someone would just step in here and aggressively would buy 5.4 Bitcoin, the market would be immediately trading at this 48,170 price, because all these orders which are resting here would get taken away from the book, and market would jump basically $40 higher. This is why any sort of a larger players are not really using these market orders, because obviously if you are buying in this case like $250,000 worth of Bitcoin, you don't want to get even getting slipped $40-50 will cost you the money. But this is what we will kind of talk about in depth a little bit later on. So the order types, there are several ways how to get in and out of the market. The limit orders are considered to be kind of a patient approach. In crypto you pay a lower fees if you use limit orders, and you don't have to pay a spread. So like I said, limit orders are preferred way for anyone who is trading with a bigger size. So because, for example, if you are trading the S&P 500 futures, where the spread is one tick, which is a $12.50 for this market, if you will buy a one lot and you really want to get in the market, you will kind of can kind of stomach this $12.50. in a spread, but if you trade 200 contracts, for example, you will much rather, kind of be patient instead of just wasting, $2,500. Limit orders are advertisement. Anyone can place them in the order book without actual intention of filling them. This is, like I said, called spoofing, and I will cover this in a bit later. The downside of the limit order is obviously the fact that you might not get filled. If you want to buy something that is trading at let's say, let me actually show you back in this kind of example. If you want to buy Bitcoin, somewhere around here, for example, but then there will be some aggressive buyers just stepping in the market, and market will start quickly moving higher, you might not get filled. So obviously the obvious downside of the limit order is that you can just get stuck with a position without actually being in a trade. The market orders are the opposite. There are the immediate execution. They will get you in and out instantly, and obviously you are paying a spread for it. Also, you might end up paying a bigger commissions during the higher volatility, where during the high impact news, basically the market makers and other large players pull out the orders from the books because they don't want to be exposed to uncertain events. If you end up using a market order, you can get really slipped, which means that your order will get filled at completely different price. So this is something that you need to be aware of. Overall, the rule of thumb is that you want to be using limit orders anytime you can. The more advanced platforms, which the platforms will be covered later on, will allow you to buy and sell at the best bid and offers, which means that you are automatically placing, as you can, let me show you this, so you know at least quickly what it means. If I can actually close this, just 1 second. Basically what it means that you are automatically placing the orders at these kind of a closest prices in the order book. So if you buy and sell into the best bid and the offer, you will more likely get filled. So, and you will save on spread, and you will save the money. Also, there are two more types of the stop orders. The stop orders execute the trades when market touch them, and buy stops are placed above the price and sell stops are placed below the price, which means that obviously they are used as a stop orders. Obviously if you for example market is going up, you will buy here and you will place your stop order below the market. Let me just draw this again because obviously it disappeared. You will buy here, you will place a stop order below the market, so if price goes against you, you will get you will be out from a trade. You don't want to be in anymore. But also the stop orders, if for example market is going up and it's currently right here, and you are working with kind of an idea that you only want to buy when market is going to break this level of resistance, you can place a stop order above the current price, which will get triggered if market will trade it from below. So you will be automatically triggered in the position at this place. This is, in my opinion, not the best way to trade, because you will see more often than not market will do something like this. But there is the option. Obviously the same goes for selling. there are also advanced order types, which are the iceberg orders, that are market orders that are not visible in the order book. These are often used by larger players because obviously they can hide their intention and just you will see them once they get executed. The limit chase, this is a type of order that is chasing the price at the best bid and offer. So you are still using a limit orders which is following the price. For example, this often happens when market is let's say you want to buy here, and market will come into your level and it hits the level, but it's not going to fill you. And this can obviously happen as well, because if at this price point you have a 200 contracts to be bought, for example, and this is often the case in a tick market such as bonds, and sometimes the S&P 500 as well. This is not going to happen to you in crypto because how thin these markets are, but in some of these thicker markets, this was thing that was happening to me in bonds almost daily. Is that if you have a level where you want to buy, you are using a buy limit order, and there is already 200 orders resting in this price point, and you want to buy, let's say, 2 lot. If you put it here, your 2 lot will, it's basically a queue, so there will be 202 lots resting there after you put your 2 lot in, but you are the last in the queue, so market can hit the level, and for example only 150 orders will get executed and market will move higher. So this means that 72 lots will kind of stay unfilled at the level. So what something like limit chase is doing, that once the level gets hit and you didn't get filled, it will start chasing the price on the best bid and the offer usually. So this is one of the more advanced orders, and it's pretty useful if for these types of situations. The TWAP is executing a market orders that are based on a certain time. So for example, you can tell the market that you want to buy a 10 lot every 1 minute, for example, and you want this to happen for 10 minutes. Okay, so after 10 minutes you will be in a trade with 100 lots, and it will every minute this 10 lot will get executed. This is also useful for example, if you don't know, if you are expecting a reversal on the market, we'll see when a kind of a market hits some sort of level and you expect it's going to slow down but eventually fall down, you can run a TWAP which will kind of slowly fill you in. For example, if you are trading crypto during the weekend and first thing on Monday you expect a reversal to the downside, from here, but it's Friday afternoon or Saturday morning, you can run a TWAP for 2 days, which will build up your short position, and hopefully market will sell off on Monday. This is not something I personally use, but there's a way. You can also plot a TWAP as a indicator on your chart, so you will see this kind of a average price for any given day or week. Also, a lot of brokers are using in crypto it for a settlement prices, the price of a TWAP, so it can be a important level for an indicator. I will show you this a little bit later on in the videos. The spoofing is this sort of a illegal practice, which, like I said, you are putting orders into the book without actual intention of filling them. So what will very often happen is that, for example, let's say that someone would, this 2 ticks above the price, there wouldn't be this 1.1 BTC offer, but let's say that someone would place a 100 bitcoins here at the offer, in here, which is unusual size for this kind of a order book here. What this would cause is that people would start a kind of a panicking and selling ahead of this 100 lot. Basically, they would see this and just kind of started drawing the market down or just market selling in anticipation that this is the sell wall, which will cause the market to sell off. But what is usually happening with these spoofers is that they will put a 100 lot here and people will start market selling, but they will actually start populating these bits somewhere around here below the price. So they put a 20 lot here, they put a 50 lot here, just kind of a bigger size, which would be harder to fill without this basically. And once they filled the size they want to be on the buy side, they will just cancel this order here, and this whole kind of a narrative for price to go down is all of a sudden gone. People realize this is spoof and they will just start buying, and market will move down, and the person who spoofed the market is now sitting with 100 lots or more on the bid. So this is how basically spoofing works. And there is a book called Flash Crash, which I'm sure most of you know, and if you don't, it's a really good read, so you might want to pick that up. So market participants, it's important to understand who you are trading against. People in crypto always talk about whales, but they don't really understand how these kind of entities operate. You can separate market participants basically into 4 groups, and they differ based on the market. Okay, it's not the same entities go into the same markets with the same intentions, but to have any kind of a general overview, at least we'll just go with it. So you have a retail traders and speculators. These are discretionary traders usually, or they can also be systematic, but they trade directionally and want to profit on a long or short market fluctuations basically. Also in this category is some kind of a proprietary trading firms or a hedge funds basically that still just kind of a speculate on the price movements in the future. Some of these are then running some unusual strategies like a carry trades, which is trading the spot and the futures contract, which I will also cover a little bit later on. Like I said, the cash and carry is basically the shorting the futures with a higher premium while buying a spot for the same coin and capturing the premium that will go in parity with a spot at the expiration. If this is for crypto and forex, the carry trade means that you are using a currency with a lower interest rate for buying a currency with a higher interest rates. These nuances is not so important, but it's good to know. The investment funds then kind of stick to a long-term game and trade the variety of assets to diversify their exposure. A lot of time they are just using markets for hedging purposes. The algorithmic and HFT firms, these are kind of interesting due to the fact that how big of the portion of market they take now. Especially the HFT firms make a large chunk of intraday volumes across all the markets. So understanding where these algos initiate their trades can be actually beneficial for your kind of a personal trading as well, and I will show you this in a second. And the last on the list are just banks and commercials. These are mostly, in forex, for example. And in forex you have this interbank market, which consists of all large banks, and they determine the exchange rates based on a supply and demand. Commercials then operate in futures mostly, but they can do it in any market. The example of kind of a commercials in futures market would be something like a Starbucks that is going to going to hedge their physical inventory of a coffee with a coffee futures. So this is something, once again, just a thing to understand. So algorithmic trading, this is the important thing, and I'm not the most experienced in this, but understanding at least kind of a basic concepts will for sure be a helpful thing for you. So for us, which discretionary traders, it's important to understand that what type of algorithmic trading strategies are operating in the market, and thanks to this you can get a edge in trading, especially in these examples, which I will cover in a second. So most people are scared of algorithms because they think they are better, more sophisticated, emotionless, so on and so forth, which for a high frequency trading firms and algorithms, this is true. There is no reason for you to kind of compete in that field, because obviously you will not stand a chance. So there are quicker, they have better transaction costs, and so on and so forth, but these operate on really the lowest time frames, so it's not going to be too much of a concern for you. For more a intraday and kind of swing trading, which will be focused here, we will take a look at more of a simple algorithms. So there are basically two types of algorithms that operate in the markets. The first ones are the delta neutral systems, which means that you don't have a directional exposure to the underlying asset, but you make money capturing spreads, doing the arbitrage, doing the carry trades, and so on. So one of the delta neutral strategies is market making. As I said, this has quite a bad reputation of being this kind of a evil entity in the market, but this is not actually true. This goal of a market maker is literally a make a market. They provide a liquidity for both sides, and their goal is to just capture the spread between those prices. Without market makers, you would have to find someone else to willing take the other side of your trade, which can be obviously an issue in some thin markets, especially in crypto and so on and so forth. So in this slide you can kind of see a simplest situation of a market maker. This is obviously the ideal way, which is not often the true, but the market maker, you have a $11 at the offer, $9 at the bid, and what market maker is doing, he will sell the one contract here, then it will buy it back here, and he's just capturing this kind of a spread between those prices. Obviously this is a kind of a unrealistic thing, because markets rarely trade simple like this. Markets are moving up and down. So for example, if market would start moving up, he would be accumulating this kind of a inventory, which he needs to kind of adjust and sell later on. But the core principle of market making is just capturing this kind of a spread. So these things can be sometimes done, manually, compared to high frequency trading. The market making can be done manually. Other delta neutral strategies can be, executed manually, but you need to understand how competitive these things are, especially kind of a arbitrage in crypto, which is obviously profiting on the mispricing of assets at the different exchanges. These things will get quickly noticed by algorithms. So if you want to do these things manually, then you might have a little bit of a hard time to do it. So but you can still take a look into it. You might find something useful for yourself. And there are also more of a simpler algorithms that are directional, and although obviously they have an edge in this sense, they are emotionless. They are just systems that follow predetermined kind of a set of rules based on a statistical edge they have, but they cannot adapt to changing market conditions quickly, because obviously their edge is in this statistical long run of taking thousands of trades, for example. But every trade can be a little bit different. So obviously this is the same for a retail traders, but there are basically two types of strategies that are implemented, also by algorithms, but also by a retail traders, which is mean reversion and a trend following. So mean reversion is just betting on a market that will return to the mean, and you can see it right here. Market is trading in this kind of a tighter range here, but once it moves up, the mean reversion strategies will trigger and bet on the market to kind of a comeback. The trend following then just follows the directions of a trending market. In a trend following strategies, you will often see tools such as the TWAP, which is this time weighted average price, which is like I said, buying a smaller chunks over a predetermined period of time. So these are basically two types of a strategies that almost basically everyone is running. But when it comes to algorithms, you can find a way on profiting on these. So for mean reversion, it usually happens when markets hit some unexpected types of events. When if you, for example, remember, this was during the COVID and post-COVID, when you had this lot of kind of a unexpected news when it came to the COVID vaccines, or for crypto this was when for example, when Elon Musk announced that Tesla bought Bitcoin, these things will obviously skyrocket the prices to the one way or another, and the mean reversion algorithms cannot adapt quickly enough to these new pieces of information. So they will trigger the mean reversion trade, but market will just continue to go up, which will force them to cover in just a seconds later, and this is kind of where you where the more pressure is created for the move to the upside. So this is where you can essentially benefit these things, and you will see it later on a footprint and delta and things like that, where you can see where some large entity was forced out of the trade, and you will be able to latch into it based on that. when it comes to trend following, you will often see this pattern, which I will talk much more later on. This kind of a slow grind up in the market. This is called a compression, and this is caused by the T-web, and just everyone is just buying. But what is happening is also there is a large accumulation of stop orders below these kind of a higher lows, which market really is doing this. It's just grinding up. Everyone is getting long. All the algos, and also all the traders are just accumulating these stops into below these kind of higher lows, and especially the algorithms will kind of track them automatically. And once market reach out any kind of a significant level, which these algos cannot really determine easily, you will just get these quick kind of a flushes throughout the whole compression, which will give you the opportunity for a trade. So that's about it. I will talk about this a little bit later on. I just wanted to kind of demonstrate how you can profit on these kind of a systematic systems where you will have these different kind of a opportunities and in these conditions. So the last thing I want to talk about are the exchange types, and there are a lot of markets you can trade, and you can separate them two parts, which are the centralized and decentralized exchanges. For the type of trading that I cover in these videos, you want to stick to trading at centralized market, ideally futures that will be used in all examples going forward. For those that are trading crypto, this can look a little bit confusing, because there are also kind of a decentralized exchanges in crypto, such as Didex, for example. But what I mean by this is that the centralized exchange will have a basically a visible order book, and kind of a everything. The decentralized exchanges in crypto, and crypto by itself is a decentralized market, but it's traded on a centralized and decentralized exchanges, which the important thing here is that they have a public order book. This is, although there are a OTC trades done in crypto, which is the way how forex is traded. The forex and CFDs are traded over the counter, which is OTC. So you don't see the volumes, you don't see the orders coming in and out. You just kind of this is not a transparent way to run a market, which is fine. There are basically two types of brokers in forex. There are A book and B book brokers. A book brokers have a liquidity providers that are executing basically and providing a liquidity, and traders are taking this ECN model basically, where they are just trading at throughout these liquidity providers. And there is also a B-book model, which means that brokers are opening the counterparty of a trades for their clients, which is not a best thing to do. Best situation you want to be, because obviously brokers can then widen the spreads during lower liquidity and stuff like that. So it's not really a best way to do it. But there is a lot of brokers in forex which are regulated and solid. So I wouldn't see things so pessimistic. Also, what is the funny thing, which most people don't know, is that even if you have a book broker which has all these kind of a liquidity providers and everything, they can still decide to run a B-book model and trade directly against their clients. So it doesn't really matter. And like I said, I'm not saying you cannot make money in trading forex. I know a lot of people who do, but you should be just aware of these different structures that exist for this market. And you know, when you don't see a volume and the orders, it's kind of a can be kind of an issue, especially for this strategy that I am about to kind of cover. Like I said, you wanna be stick into this in this site. You know, the centralized exchanges have a public order books. Every order that happens, you can clearly see it. You know, the futures are traded on CME, COMEX, which is trading a gold, NYMEX is trading a crude oil, CBOT is then trading bonds, but these are just you know, exchanges in the US. You have Eurex, you have ICE, you have, you know, all these different exchanges, but they are all centralized, you know, with a visible volumes. The cryptocurrencies that are then traded on FTX, Bybit, Binance, Coinbase, Bitfinex, you know, and even these decentralized exchanges in crypto, like I mentioned, the DiDEX, for example, they still are, you know, transparent with the volumes. So that's kind of important things. And then stocks are traded at the New York Stock Exchange and London Stock Exchange and so on and so forth. I'm not going to be covering stocks that much, or honestly at all. So stocks are just, you know, also the centralized market. So this is going to be it for the basics of the market microstructure. I hope you understand all the concepts of the important things, which are looking at, you know, orders in the order book and using the advanced type of order books. They will be covered in the future. So let's jump into the next one.